Domino's Pizza, stock ticker DPZ, is currently trading at $453 per share, and this is a stock that I actually own in my personal portfolio, and I've owned it for a while now. If we look at my growth chart, we can see Domino's Pizza right here. I'm currently up close to around 40% on this position. Now, what's interesting is if we look at the past year, they're up around 22.7%, but we can see there's a huge sell-off. They were trading as high as about $533 per share, and then sold all the way down to around $404 per share. Now, to put this into context, over the past decade, Domino's Pizza has way outperformed the market by a large amount. But what's even more interesting is it recently came out that last quarter, Warren Buffett added shares for the first time of Domino's Pizza to his portfolio, and the market reacted accordingly when they found out this news. If we look at the past month, we can see Domino's Pizza currently up around 5.77%. Now, this addition to Warren Buffett's portfolio was a small one. He added around 1.28 million shares, and we can see it's estimated that his average buy price after adding shares somewhere in this range is around $435 per share. So we can see stock is currently a little bit above his estimated average buy price. So we have a lot to dig into. We're going to look at the recent earnings report, be analyzing the valuation for this company, and deciding if it's a good stock for us to consider adding shares of to our portfolio. So let's go ahead and start digging into it. Now, like I just mentioned, they recently released their latest quarter's earnings, Q3, not too long ago in early October. Q3 GAAP earnings per share came in at $4.19, which was a beat by about 55 cents, so that's a pretty big beat. Revenue came in at about $1.08 billion, which was up close to around 5% year over year, but did miss expectations by about $20 million. Now, there's a lot more to break down from this earnings report, but again, I want to step back and help you better understand what Domino's looks like from a dividend perspective. So if we go ahead and jump over to my dividend breakdown sheet, let's go ahead and come up here and plug in DPZ. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, if we come down here, we can see Domino's Pizza has a lower starting dividend yield sitting at about 1.33%, but the dividend growth over the past decade has been mind-blowing. Look at this, a 10-year dividend CAGR of 20%, a 5-year dividend CAGR of 18.36%. So when we look at this charted out, we can see explosive dividend growth. We're talking about a company that went from 80 cents per share in dividends in 2013 all the way up to $4.84 in 2023, and we're now sitting at $6.04. So the dividend growth is pretty mind-blowing. Your yield on cost, if you were about a decade ago, would be far higher than the starting dividend yield. But here's what's really beautiful about this. Whenever we see high levels of dividend growth, if we see the payout ratio remain low, that's a very good sign, and we can see that has been the case for Domino's. Despite increasing their dividend at nearly a 20% rate over the past decade, their free cash flow payout ratio has remained in a very healthy range, and the free cash flow has been growing. We can see free cash flow in 2013 sitting at about $153 million, and in 2023 all the way up to $485 million. So from a dividend perspective, things look really good here. Everything looks very healthy. The dividend is not only sustainable, but they should be able to continue to grow it at a very high rate. But one of the things we also have to understand about Domino's, they're not just a dividend payer, they're what I would call a true shareholder yield company. Now, what does that mean? Well, again, we have to remember there's 5 different things a company can do with their free cash flow. They can reinvest back into the business, attempt mergers and acquisitions, pay down debt, or they can buy back shares and pay out dividends. And these two options are ways to directly reward shareholders. So yes, they're paying out dividends, but again, I call them a shareholder yield company, meaning they're also buying back a lot of shares. So if we jump over to my stock screener tab, let's come up here and plug in DPZ. Again, thanks to ticker data, this will automatically load in, and if we come down, we can see the company's gone from around 55.7 million shares outstanding in 2013 to the end of 2023, just 35 million. So this is a significant amount of share reduction during this time period, and to put this into perspective, if we look at the profitability sheet and look at Domino's, we can see the 10-year net income CAGR sitting at about 13.76%. But actually, if we jump over to Bogle's valuation, which we're going to look at here just a little bit more in depth, and plug in Domino's Pizza, if we look at the 10-year earnings per share growth, it's closer to 20%. So why is the EPS compounded annual growth rate so much higher than just net income? Again, it's because the company's bought back so many shares outstanding. Anytime a company is constantly buying back shares, you have to remember it's going to boost all other per share metrics. So things like earnings per share, revenue per share, and free cash flow per share are all going to be higher on a per share basis because the company is buying back shares. So this can be a really great way to reward shareholders when it's done properly. And again, this is why I call Domino's a shareholder yield company. Not only are you getting rewarded with dividends, but also with buying back shares. And we'll come back and talk about that more here in just a little bit. But if we go ahead and jump back over to this earnings report. Let's start to break this down just a little bit more. If we start to scroll down, there's a couple of different things that I want to point out. First of all, zoom in here, we can see revenue increased to around 52.8 million, which is around a 5.1 increase in the third quarter compared to the third quarter of 2023. So not necessarily a high revenue growth rate, but we'll keep that in mind. We can see US company-owned store gross margins increased by about 1 percentage point in the third quarter of 2024 compared to the third quarter of 2023. Okay, let's talk about gross profit margins for a second. Again, if we jump back over to the stock screener and go over to our profitability sheet, we can see one of the things that Domino's has done over the past decade is their gross profit margins have been increasing, just like we saw in the most recent quarter. In 2013, the gross profit ratio is sitting about 30.46, and if we look at where it is at the end of 2023, sitting about 38.56. So over just a decade time period, it's a pretty nice increase in the gross profit ratio. Look at the 10-year average, 34.75, and last year, 38.5. That can really make a difference on the bottom line, so that's a good sign. Now, if we go ahead and jump back over to our earnings presentation, we can see net income actually decreased by about 0.8 million or 0.5% in the third quarter of 2024 as compared to the third quarter of 2023, due to higher provision for income taxes. And one of the main reasons for this was driven by lower foreign tax credits. So yes, net income did drop slightly, but keep in mind revenue was growing, income from operations was technically growing at about 5%. Bottom line just dropped a little bit because of tax reasons. Now, if we keep scrolling down, a couple more things that I do want to point out. We already talked about the dividend. Yes, the company's paying dividends and growing at a high rate, and then they're also buying back shares. And then if we zoom in here, we can actually see something interesting. 2024 guidance. The company now expects the following given the challenging macroeconomic environment and its impact on current business trends across the globe. Approximately 6% annual global retail sales growth and approximately 8% annual income from operations growth. So after looking at these other growth rates that we've already seen, double-digit revenue growth and net income growth, is all of this starting to slow down? Is Domino's Pizza not going to be the same stock as it was over the past decade? Well, here's what we have to understand. If we take a step back for a moment, let's look at the industry that they're in as a whole, the pizza market. We can see it's estimated from 2024 to 2032, the compounded annual growth rate for the global pizza market is expected to be around 11%. So this is a quick growing market. It's projected to have a lot of growth over the next decade, and Domino's Pizza is probably in a better position than anyone to capitalize off this growth. Now, one of the things we also have to understand is when we look at this, they're projecting long-term guidance of about 7% annual global retail sales growth and 8% annual income from operations growth. Yes, that is good, but look what's pointed out in their investors presentation. If we zoom in, look right in this area right here. Our operating income will grow at 8%, meaning we intend to grow profits faster than sales. As with sales and stores, the plus on our 5-year profit outlook means 8% represents what we see as our floor. So that 8% is on the low end of their expectations. That's what a lot of people are missing right now. So in reality, growth could be much higher than just 7 to 8% when it comes to sales and profit. Now let's take a moment and actually talk about one of the concerns a lot of people have with Domino's, and I've mentioned this before on the channel. If we jump over to the balance sheet breakdown, come up here and plug in DPZ. Here's what scares a lot of investors. Look at total assets. We're sitting at about 1.775 billion, but look at total debt. 5.2 billion, giving them a debt to assets ratio of 2.93. That's a really high debt to assets ratio. And we can see, historically speaking, they've typically had a pretty high debt to assets ratio. So how concerned should we be about this? And here's what we have to understand. This has to be in context. Yes, this is undoubtedly a high debt to assets ratio. So to put this into context, we need to look at the interest coverage ratio. Now, what is this telling us? Well, this is a metric that measures a company's ability to meet its interest payment obligations. So how easily can they make the interest payments on this long-term debt? And it's calculated by dividing a company's earnings before interest and taxes, which is EBIT, by its interest expenses. And generally speaking, for companies like Domino's, you'd want to see the interest coverage ratio be at least around 2.5 or 3 or above. And we can see over the past few years, it's easily been meeting that interest coverage ratio. We were sitting at about 4 here in 2022, and over the past couple of years, it's actually increased closer to around 4.5. So is there a lot of long-term debt? Yes. Could that potentially be a problem? Absolutely. Debt always increases a company's risk. But what we've seen from Domino's historically, and as of right now, is they have been in a healthy position to make those interest payments. Something else we have to talk about to put this into context is Domino's is actually a very asset-light business, which is not what you would expect at first. Domino's Pizza has a franchise business model, and 99% of their stores are franchised. So So Domino's revenues are actually primarily generated by royalties and fees that the business owners pay to the parent company. And what this allows is for Domino's to rapidly expand. And it also makes their business very asset light. So in reality, total assets being way lower than total debt has actually been one of the keys for Domino's being able to grow at such a rapid rate over the past decade. And again, from a debt perspective, if we look at the short term current ratio over time, they're actually in a pretty healthy position, so they don't have to worry about meeting short-term obligations. Yes, long-term debt is large, but again, the interest coverage ratio over the past decade has proven that they can easily make those interest payments. So what initially appears to be a weakness for Domino's in reality has actually been somewhat of a strength for them over the past decade. So it's easy to see why Domino's is an attractive stock for a lot of reasons and why it's done so well over the past decade. But here's one of the main problems a lot of people have with Domino's right now. Look at this forward price to earnings. It's sitting at about 26.67. That's relatively high, and it's obviously a lot higher than most of Domino's peers. So most people would argue this stock does look a little bit expensive at its current prices, but I want to take a step back and look at this from a unique valuation perspective and look at it from Bogle's valuation. Now, I haven't used this a lot on the channel before, but I have done it a few times, but I think it makes a lot of sense to look at Domino's through this lens in this scenario, and I'm going to show you why as I go through this. Now, I've already plugged in Domino's right here, and we can see when it comes to Bogle's valuation, there's three different things that we're going to look at, and this is what drives shareholder returns over the long term. We have earnings growth. Obviously, when a company grows earnings, the intrinsic value grows. We have shareholder yield, which like we talked about earlier, combines dividend yield and buyback yield to get a realistic view of how much you're being returned to as a shareholder. And then we have multiple expansion, and all multiple expansion is telling us is how much someone is willing to pay for Domino's on a per share basis again. So we can see price to earnings multiple right now is sitting at about 26.67. So right now people are willing to pay around $26.67 for each dollar of earnings for Domino's. But if this went down long term, that would mean they're seeing multiple contraction. And if it went up long term, it means they're seeing multiple expansion. And typically this is going to be determined by things like the quality of a company or the predictability improving. So if we jump back over to Bogle's valuation again, let's look at each of these three things. What we've already been told by management is on the low end, we can expect earnings growth of around 8% over the next few years. So let's just go with 8%, even though they're saying that's on the low end. So we're talking about kind of a worst case scenario for Domino's. I'll hit enter, and then we have shareholder yield. If we come over here, we can already see the starting dividend yield for Domino's is sitting at about 1.33%. But then we have buyback yield, which if we come down here, we can see each year what percentage of shares they're constantly buying back. So in 2019, they bought back around 2.6% of shares outstanding. 2020, 4.4, 2021, 4.56, and 2022, 3.96. In 2023, a little bit less at about 1.8. So the average buyback yield for this company over the past 5 years is sitting at about 3.5%. So again, buying back a lot of shares over the past few years. So let's just assume, again, it's going to be on the lower end. We're going to go with a worst case scenario. Maybe it's sitting at about 2.5 over the next decade on an average basis. We plug that in, you can see we get a shareholder yield of about 3.83%. So far with earnings growth and shareholder yield, we can get an average annual return over the next decade of around 11.83%. But now we have to address multiple expansion. Again, in this scenario, we're assuming a worst case scenario. So what could be the worst thing to happen to Domino's? Well, maybe their price to earnings multiple that the market values them at continues to contract. So let's say over the next decade, their price to earnings multiple falls by 20%, which would be around 2% on an annual basis. So if we come over here, we can come up here and do -2, which again would be 2% on an annual basis over the next decade. So with earnings growth, shareholder yield, and even a negative multiple expansion, you can see with Domino's over the next decade, we're getting an expected annual return of 9.83%. And in a lot of these cases, it's assuming a worst case scenario. So based off this valuation, you can quickly see why a lot of people, like Buffett himself, do like Domino's Pizza right now. Especially when Domino's has positioned themselves as one of the leaders in the pizza market, a market that's expected to grow at a compounded annual growth rate of close to 11% through 2032. And over the past year, we have seen Domino's start to make moves to continue to position themselves to benefit from this growth. We can see they partner with Microsoft for AI purposes. If we come down here, we can get a quick snapshot of what this looks like. This is expected to transform Domino's consumer experiences by enhancing the ordering process through personalization and simplification. So again, that goes back to cost savings, which again would also improve the gross margins, which they've already been benefiting from over the past decade. So I've been bullish on Domino's for a while now. I've held them in my portfolio for a while, and I've definitely reaped the benefits. Again, I'm currently up around 40% on this position, and when I look at the moves they're making, the way they're currently positioned in the market, the expected growth in their market, and I look at things like Bogle's valuation, I continue to be confident in this company, especially when you look at them from a long-term perspective. Again, when I look at that price price to earnings multiple. Yes, a lot of people will point out it's kind of high for a pizza company, but even if you look at it from a historical perspective, you can see they're actually below their average 5-year price to earnings multiple right now. So compared to how they've historically traded, you would actually argue that they're undervalued. But again, even in the case where we see over the next decade that price to earnings multiple drop by 20%, we're still looking at an expected return of close to 10%, and that's annually. So go ahead and let me know what you think of Domino's Pizza in the comments down below, if you plan on buying just like Warren Buffett is, or if you plan on staying away. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.